Hey, what's going on, ADPI Nation? This is your host, Kevin Brenner. And today I bring, once again, another fantastic guest from the ADPI community. David Sanford is joining us. He's active duty Army. Yes, Army?
Yep, active duty. Well, Army National Guard, AG1.
Army National Guard. Excuse me. Army National Guard. But David, actually, I mean, I've been watching his story for some time because he's always kind of active in the community, in the ADPI community. He's posting in the Facebook group, and he's making some like really interesting, creative power moves with real estate. And finally, actually, I kind of like approached him years ago. I was like, dude, you should come on the podcast. He's like, I don't know. I'm not ready yet. I'm not there. And I was like, you're there. Trust me. But then a week ago, out of the blue, he texts me and he's like, hey, can I come on the show? And I was like, yes, finally, yes. So we're going to be talking a lot, kind of just, we'll dig into David's background, but he does some really interesting creative deals. So if you're interested in some creative finance techniques or just kind of some stories about how you can get into deals for little of your own money, then this might be the podcast for you. So I hope you enjoy it, and let's shoot, man. David, let's jump right in. Let's start. Question one: What's your just general military background? Your military story.
Yeah, so I joined the military. I was 19 years old. I was working at a pizza restaurant, working way too many hours, and I wanted to go to college like the rest of my 19-year-old friends. So found the National Guard. So I joined at the age of 19 as a radar repair. So initially I wanted to go active duty, but my girlfriend at the time was like, no, you can't leave. So uh, yeah, so I ended up going National Guard, but I told my recruiter that I just wanted like the longest job he could find me, just so I could get like a taste of the active duty life for a little while and be just kind of leave home for a while. So he did that. I think the longest AIT was a 94 mic. At the time, it was like 56 weeks or something like that.
Wow. So you went away like 56 weeks. You're like,
Yeah,
gone.
yeah. It ended up being like a year and a half once you include like basic training and then like block leave for holiday block leave and whatnot. But it was a while. So I did that, and then a few years later, I changed my job over to be a radar operator um, for promotion. And
Mm-hmm.
then from there, just kind of changed my job again to a diesel mechanic. I did like a little bit of human resource work for a while, and now, 14 years later, I am serving as a recruiter full time for the National Guard in Virginia.
Okay. Awesome. Well, let's see if you get me signed up by the end of this podcast.
Yeah, yeah, definitely. You're close to Virginia, right? I mean,
You're close. Wow, man. Yeah, there I am. There you go. So anyway, man. No, so National Guard. Now, was this a lot of your time? Were you activated on full time orders or not so much?
so it was like I said, I joined in 2008. It was late of 2008. It was December of 2008. I didn't leave for basic training or anything until I think March of 2009. Came back home in I think June of 2010. And then I didn't do any kind of active duty stuff until like 2014. So it was about like a
Mhm.
4 year gap there where I was just a reservist. Still working at the pizza restaurant. I went back there while I was going to college. And it's kind of, which that was kind of a beast, kind of working full time and going to college full time. But did that for a few years, got my bachelor's degree in finance, and then I tried to hit the job market. That was probably 2015 or so.
Mhm.
Couldn't find a job that I wanted. Well, a job that because at the pizza restaurant I was making, I think at the time it was like 50,000, and I was getting job offers in the finance field for like 40, and I just didn't want to take that step back. So um, turned it down, and then I started looking at full time active duty National Guard positions. So it was right around 2015 or so is when I became full time.
Okay. All right. Interesting. So, um, and just going back, you were able to use your military benefits to go to college. Like that was the whole point, right? So once you came back from basic training, then it's like, okay, I'm going to go to college now, and uh, you were able to use what the scholarship program or something like that.
Yeah, so the National Guard they pay at the time it was like they would pay like $11,000 a year for your tuition. Now it's like $24,000 a year, so it's pretty well in Virginia. Every state's a little bit different, but um, yeah. So when I came back from AIT, my job training, I went to the local community school, graduated with my associates there. I think it was just general studies, might have been business, I can't really recall, but and then I transferred to like a 4 year institution, got my bachelor's in finance, and then I transferred finished out my master's degree and just got my MBA back in
Nice.
2019.
That's awesome, dude. So at what point for you then did real estate come into play?
Yeah, good question. So around that same time when I was graduating with my bachelor's degree, like 2015 or so, that's when I stumbled across Rich Dad Poor Dad.
Hmm.
And that's like the most common book. Like if you're an investor and you haven't read it yet, you gotta you gotta jump on
You
it.
got to read that. I don't
Yeah,
think you got to beat that horse to death with this audience because I think I do it every week. That
yeah,
horse is dead.
yeah. That book, I love that book. I mean, it's very inspiring. I mean, I've probably given out a dozen of those books just to kids in the neighborhood like pushing a lawnmower, cutting grass. Like obviously, they've got a drive, so I've given them books and kind of hand them out pretty frequently. But yeah, so I read that book in like 2015. Really inspired me. I got my bachelor's degree at the same time my wife finished up her bachelor's degree. She became a registered nurse, so we started making a little bit better money. We bought a house back in 2012 to live in.
Hmm.
So 2015, once we got better jobs, we looked for a bigger house. So, and it just happened to be perfect timing. It was right when I read Rich Dad Poor Dad. So I was like, let's instead of selling our first house, let's rent that out and just see how that goes. So we did that, rented it out, and then just got the itch, got the bug from there.
You know the crazy thing? Because we talk about this, and like everyone probably listening to this podcast is like, oh yeah, just like rent it out. It's like second nature. But the majority of people, they don't even think that. That is like the worst possible thing to them. They're like, why would I want to rent it out and be a slumlord? Like, why?
I
That's
know.
but that's what like normal
Yeah.
people think, and that's how we're conditioned to think. So if you kind of just dissect that a little bit and just like kind of swirl that around in your brain, you're like, wow, there is way less competition from other investors out there because most people don't understand. Like they're just
Yeah.
like you say that and you're like, for us, it's like, oh yeah, I read Rich Dad Poor Dad. Of course I'm going to rent it out. But
Yeah.
like everyone in our circles has read that book. You're handing that book out to people cutting the lawn. You know what I mean? Like, but
Hmm.
normal people out there, like even family, like my family, I try to like say like, aren't you should like definitely rent that out. And they're like, oh no, no, why would I ever do that? I don't want to do that. And I was
Yeah.
just like,
Really.
all right.
Yeah. Yeah. I know a lot of people they worry about like the debt to income ratio and think that that's gonna they won't be
Yeah,
able to buy
exactly.
another house, but it I mean it can help. So and it's funny
Yeah.
because that first house that we had bought back in 2012 that we were renting out like our first rental property.
Hmm.
I think our mortgage at the time was like 850, right around there. And I remember like I just Googled like property manager in Chester, Virginia. Like
Yeah.
didn't do any kind of research on like what to look for in a property manager or anything. And I just found the first company. I called them up and I was like, hey, I've got this house. We're thinking about renting it out. Um, I'd love for you to just come take a look. And like I said, my mortgage is like 850. And I remember telling my wife, like, if we can get like 1,000 a month, I'm happy. Because I didn't really understand like
Hmm.
capex, maintenance, but vacancy and all this other stuff that goes into it. But so they came out to the house and they were like, yeah, you can probably get like 1,300. I was like, whoa, like I was cool with 1,000. You think we can get 13? So that was a good one. We were profiting like 450 a month off of it, and yeah, it was just like I'm so glad that we decided to do that because once we did that, uh, we saved up some capital and then we bought like our first true rental,
Hmm.
2020, about a year later, I guess, 2016.
Okay. So 2015, and at this time you're kind of in the pizzeria. You're looking in the job market. You got this bachelor's degree. You're kind of all over the place, but you're like, okay, let's turn this into a rental. You're still a National Guardsman, but you're not like kind of activated. So
Mhm.
you got to do whatever your minimum amount of time or whatever, and then you're doing that, and then you said you picked up another one. What did you pick up? Was it another single family?
Yeah, so the next one, like I said, we did that first one for a while. We really enjoyed it. The cash flow was great. It was very easy because we immediately outsourced it to a property manager. So, it was very hands off. We just kind of sat back and collected the check, really. Um, and then, yeah, so it was probably about the summer of 2016. We started looking for our next rental property. And then we found one on the MLS. This was, it was easy to find deals on the MLS at this point in 2016.
Mm-hmm.
So this one, I think they were asking like 98,000. It was just south of Richmond. Still in Chesterfield, if anybody's familiar with the area, but it's south of Richmond, kind of like on the border. So it's kind of like a C area, I guess. But I think they were asking 98,000. We put up our offer for 90,000, and I think we ended up settling at like 92,000. Um, it was, yeah, we saved up the cash. We put down our 20%. So, I mean,
Mm-hmm.
18,000 or so. Then we put in like new flooring, new paint, appliances, maybe put in another 10,000. So it cost us roughly somewhere between 25 or 30,000 to kind of get that one rented. But once we did, our mortgage on it was like, I don't know, 550, 600, something like
Something
that,
like
and we
that.
rented
Yeah.
it. Yeah, it was around there. We rented it right at like 950, maybe 1,000 or so. So
There you go. So
yeah.
you got the one rental cooking for you at around 450 in cash flow. Now, let's be real. There's going to be a certain amount of that you got to do, say for maintenance, for vacancy, and for capex, which is
Sure.
normal, right?
Yeah.
But you already have property management in play. So, you know, let's say at the end of the day you're getting from that first rental, you're getting $350, and then a year later you get this other one and you have it set up, and you might be getting another, call it $350. That's $700 a month
Hmm.
coming into you guys in extra income. And I call this streams. So, streams of income, right? These are all little streams and they build up into a tributary, and then a tributary leads into a river. And these are horizontal streams of income because, David, at this point, for our listeners out there, you are not trading your time for money on this. Like,
Hmm.
you have a job at the pizza place. That's your vertical income. You are physically trading your time for money. Your
Yeah.
horizontal income is coming in from the sides. It's coming in this way, and it's not being affected by that trade, and you're slowly building your wealth. And this has nothing, obviously the equity is building in these places as well. So it's it's really, really incredible to think about it like that, how increasing your streams of horizontal income can build into these little tributaries, and these tributaries eventually build into this river of cash flow. It just takes time.
Yeah.
So for those people out there who are listening who are thinking about this right now, think to yourself and be candid with yourself. How many streams of income do I have, and are they vertical or horizontal? Those are the questions you need to be asking yourself. So, David, I love that. So, all right, you got this house. Then what?
Yeah. So then, yeah, so we got that house. At this point, we had two rental properties. And then, we saved up money as fast as we could. And then it was roughly, it didn't take very long because, we didn't have kids yet. And we both had decent jobs. We had the profits from the first two rentals, but I think maybe like 6 months later, we saved up enough cash to buy our third rental. Um, Same thing, bought it. I can't remember the numbers, probably 70,000 or so for this one. Decent cash flow. And then we just saved up capital. And it was like, we did that up until we got to like six properties or so.
Mm-hmm.
And then I was like, this is really cool, but I want to go faster. So, it took time. But so I think the next deal was kind of the bigger deal is it was three houses, like three next door to each other. And I
Mm.
bought it like on seller finance terms. Only had to put down $1,000 per house. So for
Wow.
$3,000, I got three rental properties, and yeah, these I think I paid 180,000 altogether for them. Put down $1,000 per house. I put down $3,000, and then, but the catch was I had to pretty much what the house was renting for. I had to give that to the seller, so I wasn't making any kind of money. But I knew that I had so much equity in the deal that as soon as it seasoned, I could go straight to a bank and take out some long term debt and pay off the seller.
I see. I see. Because I was like, what's the play here? So this is, let me break this down because, um, first of all, like going back and saying like, yes, it takes time. Another thing that you're probably facing is conventional, you're going to start running out of conventional loans.
Oh yeah.
And your personal debt to income ratio, the bank's going to look at you and say like, oh, well, great, you're getting this cash flow from these rentals, but eventually it's not going to be able to cover it, and you're not going to be able to use that conventional loan. So I love going around this and talking creative financing here. So seller financing, let's break it down Barney style.
Mhm.
What is it?
So basically, instead of because a bank, they're going to have all these rules and regulations and things that they've got to cover. So there's a standard set of rules, and then every bank has what's called like overlays. So basically, it's the bank's rules on top of like the federal government rules for loans. So um, when you go to a seller, basically they're acting as the bank, so the terms are extremely negotiable. You can, I've done some like 2% loans, seller finance of, like this one I did, like where okay, I'll just give you the full rent check. Um,
Mm-hmm.
they're not going to, or they don't have to go into like dig into your credit scores and debt to income or anything. You just basically write up a note and yeah, the deed of the title, you own the house now, but it's backed by their note.
So yeah, I'm just, I really want to kind of dig into this because you're absolutely right with banks and overlays and rules and all of this stuff. The seller finance, it's creative, It's a way for people to get in for little to no money down. But what is the pitch? Like, why would a potential, first of all, what type of house can you even seller finance? Because if if the seller has a mortgage on the property, you probably can't seller finance it. Like most, they have to be first visit, like they have to uh, own it outright, right?
Yeah.
So like that eliminates a lot of potential properties if you're looking to buy from
Mhm.
someone. So from that perspective, what is the pitch to the seller? So say someone listening to this podcast, they find something, they know it's owned outright, for whatever reason. Maybe the person's been in it for 30 years. Maybe they bought it cash years ago. Who the heck knows?
Yeah.
What's your pitch, David, to this prospective seller? Like you're the buyer, they're the seller. Why should they seller finance it?
Yeah. So typically, the first thing I do is whenever I get an address or a lead or something like that, um, there's tons of platforms out there. I use PropStream. So I just type the address in there, and then usually that will tell me like if they own it free and clear, or if they have a mortgage on it. It's not 100% accurate, but it's usually pretty close. So it's a paid service. It's $100 a month. If you're new, I wouldn't really suggest getting a subscription to it, but you can always reach out to somebody that does and just say, hey, do you mind typing in this one address for me or something like that. So um, then I'll know like, okay, the seller owns it free and clear. So at that point, I can try to just kind of talk to them, figure out why they're trying to sell it. Maybe they're a tired landlord, maybe they want to cash, whatever the situation may be. So usually what I find is they've owned the property for a number of years and they're just ready to kind of leave the business a little bit. So then I'll just talk to them, like, are you trying to just get all the cash you can and move it into something else? What do you plan to do with that cash? Do
Mm-hmm.
you just don't want to manage it anymore? You can act as the bank and I'll just pay you so you don't have to worry about dealing with like tenants and repairs and vacancy and all that stuff. And just try to figure out what their goal is, why are they trying to leave the property and if seller financing is a viable option here.
Yeah, and that's one of the biggest pitch points is finding out where the seller is in their journey, because everyone is on their own different journey. I mean, David, you and I are younger dudes. We're kind of building up, right? We're like in the
Mhm.
build up phase. But if you're talking to someone who's approaching retirement or heck, maybe is already retired, and they're like, yeah, I just don't want to manage these anymore, and I'd love the monthly cash flows for a while I go and do whatever.
Yeah.
Great. Like that is super appealing to a lot of people. Like, think about it. Like these three houses. What was the total rent roll that you were paying them?
Oh, it was way under rented, which is another huge plus. But I knew that I think he was renting them for
Mm.
like 650 a house,
Oh wow.
and these are like $900 houses.
So
Not
you
not a
so you had to pay him the 650 a house. So whatever,
mhm,
call it 707. You at the end of the day, he was getting $2,100 a month in
mhm,
for doing absolutely nothing for as long as you had these houses
mhm.
until you can pay them off. Um, One thing you mentioned, prop stream. So I do want to put a note out there for everyone. ADPI, we have negotiated an excellent deal with PropStream. Like
Oh,
PropStream
cool.
does not give this out. So if you go to trial.propstreampro.com/ADPI, you get 30-day free trial of PropStream. So normally it's only 7 days. 30 days free. And you can do a lot in 30 days as
Yeah,
far as
yeah,
finding
really.
properties and like a lot in 30 days. So, highly, highly, highly recommend you take advantage of that. Again, that's trial.propstreampro.com/ADPI to take advantage of that trial. That was a long negotiation that we got, but they freaking love ADPI and we love PropStream, so it's awesome. Um,
Yeah,
sorry, David. Yeah. So the seller finance, you're pitching them, you're finding out what are their pain points, you know. And the great thing about seller financing is so negotiable. Like anything is on the table,
yeah,
anything is up for discussion. And we're going to talk about some deals that you did that's like really weird, but just in these. So you go and you get these three houses. In your back pocket, that one, they're under rented. The guy probably had them on autopilot at 650 a month, and they could be
yeah.
$900 a month. So is that what you did then? Once you closed, did you go and raise the rent, or did you kind of just like let them chill and wait for the seasoning to come through?
Yeah, so of course, I did the research. They were all month-to-month leases, so that was another plus. I could get them out
Hmm.
quickly or increase their rent quickly. So yeah, so we picked up the houses. I can't remember if there was just like one. It might have been two tenants I had to get rid of, just because they wouldn't pay the new rent.
Hmm.
But either way, I gave them the notice that their rent was going to be increasing soon. So we upped their rents about $900, and then 6 months later, I went to the bank, and I was like, "Hey, I've got these three houses. They're deeded in my name. There's a seller loan on the back of it. I
Hmm.
just want to refinance them and pay the seller off. So that way, my mortgage, instead of giving the seller that 650 a month or whatever it was, my mortgage came down to like 350. So I was able to cash flow a lot more once I went into like a long term debt. So
Hmm.
yeah, they home run deals. I mean,
Yeah. So what were let's talk structure of this seller finance and this promissory note. So for folks listening, a promissory note is kind of the vehicle that that you're legally, it's a note, right? That you're legally going to agree upon between the seller and the buyer. In this case, David, you're the buyer, right? So you get the promissory note up, and there's a secured promissory note and there's an unsecured promissory note. This is a secured promissory note because the seller who currently owns these properties is in first position on these. So, David, if you stop paying for one reason or another, boom, properties are his again.
mhm.
So that's how it works. It's secured by the deed of those properties. So what were some of the, like, what do the terms look like? I mean, you came to this guy, you found out, so in your head right now, you found out what? They're under rented. You know that he's willing to do seller finance, and for one reason or another. How do you approach him, and how do you set up this promissory note, and what does the nitty-gritty look like?
Yeah. So this gentleman, he's actually the same person that I bought my second rental from.
Oh,
Um,
okay. So you had a relationship already.
yeah. Yeah. So when he was looking to sell these three, I guess he thought of me and he called me up and asked me if I wanted them. I was like, hey, I do, but I'm out of cash. Like I just can't do it. So he's like, well, what can you do, basically? So for that one, that's when I was like, okay, well, I'll give you $1,000 down per house. But like you said, I knew that it was under rented. I knew that they were month to month, and I knew that at $60,000 a pop, that was too cheap.
Hmm.
They were probably worth 90,000 each, as they were. So I knew that there was a lot of equity there. So I knew, just because of prior experience, that I could go to a bank and take out a loan and they give me 75% of what it was worth. And that 75% would cover what I owed him.
Yeah. So
So
now, what about interest rate? Though you were paying him interest now.
yeah, I mean, well, so the entire rent check that I was giving him was just interest. I still owed him $180,000.
Ah,
So he
so
made
so
a
that,
lot.
yeah, yeah. So okay. So this is a good point, because the way you guys had set this up, you're like, okay, I'll give you $1,000 down for the house, um, just to pretty much tell you that I'm serious, right?
Mhm.
And then on top of that, you guys had worked it out where it's like, hey, I'm just going to continue paying you the rent that you would normally get. So 650 a house. So whatever, I don't know, math in public, whatever that comes to,
1950.
1950. There you go. So you're paying him 1950 a month, and I don't know if you guys calculated that, like, that's X% interest of this, or was it just written into the promissory note that I'm going to give you 1950 a month, and that's what it is. It is what it is. But like, you have that, and what's the deal with this, like, seasoning period? What does that mean? Can you explain that for folks?
Yeah, so the banks, and I've since found kind of ways around it, but so most banks want to make sure that you own a house for at least 6 months. The title seasons for at least 6 months before you can refinance it or do anything with the house. So um, I've now found banks that don't have any kind of seasoning requirement. Some
Mm,
banks have 12-month seasoning requirements. It's all over. So you really just gotta shop around and know what your bank's looking for. But at the time, I was using the same bank for every single purchase, so I just asked that one bank, like, "Hey, what can you do here?" And he's like, "Well, 6 months later, just come to us and you can pay us off." So,
yeah. So
um,
and so 6 months, you go in, you raise, you recycle the tenants and you raise the rent. So now, even though you owe this guy 1950, you got 900, you got 1800 coming in. I'm sorry. You
27.
wrote it at 19. It was $900 a month, right? That's what you were charging
Yeah.
the new rent.
So, mhm.
I'm sorry, $2,700. So, if anyone can tell, I'm using my phone to be a calculator because this is not what I do. But point is, you raise the rent, you got to pay the seller, right? You got to pay him his 1950. Well, now rent's up to $2,700 a month across the
Mhm.
portfolio. So you're cash flowing $750 a month. Well, you got to wait 6 months so the bank can do its whole seasoning thing, and they know that David is now the owner and all of this stuff. But you still owe this guy like this 1950 that you're paying him every month. That's not taking down the principal. That's interest only. So it's
Mhm.
really important to understand what an IO payment is, interest only, and when you're structuring that deal. So in a lot of cases for buyers like David, interest only is actually super beneficial because you don't have to pay the principal. Like, you know,
Yeah.
um, and was there a balloon on this, David?
So I just not according to not on like we didn't deed it or anything like it wasn't on the
Mhm.
note that there was a balloon or anything like that. I just told him like verbally like, hey, I think I told him within 12 months I'll pay you the balloon, but
Yeah.
there wasn't. Which looking back, he was super trusting in me. Like I was
Yeah,
just
I know, right?
uh,
I'm just thinking about that. I was like, wait, it wasn't on paper.
no, it was just a verbal agreement. Like, hey, within 12 months
Ooh.
I'll pay you the 180 that I owed him. So
And
yeah,
so running the numbers on that, you knew. So you had to get appraisals on these houses, no?
yeah.
So what did the
Well,
appraisals come back?
yeah, I think they each came back roughly 90,000 each, somewhere around there.
Okay, so 90,000. Uh, so each house 90,000. So 270,000
Hmm.
is the bank came to you and said, hey, these houses, all three of them worth 90,000. So 270,000, and we're gonna give you, typically it's 75%, maybe 70%, maybe
Yeah,
80%,
yeah,
usually in that. So we're gonna give you 75% loan to value (LTV). So the bank cuts you a check for $202,500,
exactly. Yep, yep.
and then you go and so you drive your car to the bank, you get this check, and you go and deliver that right to the seller and you pay him off. So some
Hmm.
things to note in this promissory note that you're setting up, and the structure of the seller finance, which is really what I'm getting at here, is interest only payments. You want those, right? Those are good.
Yeah, for sure.
Um, usually there's a balloon in the note, but I don't know. Like, I guess he was just like, "Yeah, David, you're cool." I highly recommend whatever you guys negotiate, put it on paper just to protect you and the
Yeah,
seller. Usually, you want to do that, but whatever, um, is what it is, right? So usually there's some sort of balloon payment, and give yourself time, right? Things happen. Like I was talking to someone earlier today and they were talking about a flip, and he was the lender. So it was kind of flipped. He was the private money lender, and they set up a 6 month balloon on a flip. I was like, 6 months? Like
so much
most
can
balloons are
happen.
like, so well, yeah. Well, luck they didn't close for like 9 months or 12 months or something, but like,
Hmm.
you know, he didn't charge him anything or anything. I was like, dude, you could have like wiped him out with that, because they had it on
Yeah,
paper and everything, but he ended up not. But the point is, as a buyer, when you're setting up this promissory note for seller financing, give yourself some time, like I would start at 18 months. Like, give yourself 18 months, balloon, whatever. Um, if you're doing interest only, you don't have to worry about an amortization schedule, but a lot of the times, sometimes it's interest only payments for X amount of months. So when you're negotiating, setting up the seller finance, David, you knew that 6 months you were going to be good to go because of the seasoning. You're going to go to the bank, what we just talked about. But sometimes if it's a bigger project, you might want to say, okay, I'll do an 18-month balloon. So that means I got to pay you the whole balance that I owe you at the end of 18 months. And I'll do 12 months of interest only payments. After those 12 months, we'll do uh, principal and interest on a, I don't know, whatever, 30-year amortization schedule or something like that. And you can drop a little amortization table and whatever. So that motivates that gives the seller a little bit more assurance that you're going to get this deal done in 12 months. So there's a lot of ways that you can manipulate, a lot of levers you can pull in setting this up. And at the end of the day, in all negotiations, two things that I want you to know, if you're listening to this podcast right now, is one, confused mind says no, and two, keep it simple.
yeah,
So keep it simple, and a confused mind says no. So like, if you're pitching, don't come like full guns blazing with this super creative and thing.
and all the lingo
Start
and
simple.
yeah,
Yeah, and all the lingo, just start simple. Talk to the person, get to know them, and work it from there. But bringing this story full circle, you go to the bank 6 months, you get that check for $202,500, which is 75% of the total value of what these houses were worth, 270,000, and you go and give that, you pay off the loan. So
For
you
100.
owed him what, 180,000, right?
Yeah, yeah. So on this one, yeah, like you
So
said, I
you
got the
made
check for 200.
yeah, so you made $22,500, give or
Mm-hmm.
take, and you're left with, after that deal, after you paid his $180,000 off, you no longer have to give him any of the rent anymore. So all that rent is coming to you. And what was your new mortgage payment on that portfolio loan?
Very low. I think it was in the threes. We'll just say 400.
Wow, because it's on a 30-year amortization now.
Yeah, 30-year and rates were, still very low at that point.
Mm-hmm. So
Um,
so now your mortgage payment, which I mean technically you didn't your note. I mean it's a note, right? So your first note you were paying the guy, whatever 650 times three. You were paying him 1950 pretty much to
mhm.
run these houses. Now you leave the bank, you end up with $22,500 in your pocket just as residual, and now your complete mortgage payment is $400. Wait, for all three houses it was 400 or 400 each?
Each. I wish it was all
Okay,
three.
all
That would
right.
be
Yeah, I
better,
was just
but
like, wait, what? I was
still a
like,
solid
what?
deal. But
Okay, so now your mortgage payment is $1,200, and oh, by the way, you've raised the rent, so $2,700 total rent roll minus 1,200. You got $1,500 a month in cash flow. Call it $1,000 a month after you save for maintenance,
yeah,
the
property
variable
management.
expenses. So you walk away with $22,500 in your pocket, three houses, and $1,000 a month added to the we calculated the additional $700 that you were making already. So, I mean, the point I'm trying to make here is that if you can think creatively, it's not it's not as hard. Like real estate is not like cut and dry. It doesn't,
Yeah,
get the deal done, but talk to someone and talk to them at a level that they understand and get to know them and understand that, hey, this person that I'm doing this deal with, they might have future deals.
yeah, yeah. I mean, that guy, like I said, I bought the first house from him. I got these three from him, and then later down the road, I think I bought another three from him. And
That's
some people would
incredible.
say like this package of three deals that we're talking about, where I got paid $20,000 to get three houses that cash flowed, X
Yeah.
amount. Like a lot of people would think that, like I wouldn't have got that if I didn't have that network, if I didn't know him. But like, and if you're not getting your name out there, you'll never you'll never build the network that you need to build the life that you want.
Yeah. Yeah, 100%. And we go back to horizontal income streams. So at this point, before you got these three, how many houses did you have? How many rentals? Were you up to three, I think, at that point?
When I got these three, I think
Or no, you were
that
up to six. Yeah, you were up to six rentals, I
yeah, I
think,
think
right?
this put me right around. It was right around the limit where you can only have 10 mortgages in your name. I remember that.
Right, right. So you were at like six, so maybe nine or 10. So at the end of this deal, you had like 10 whatevers. You had like, 10 homes. Um,
Mm-hmm.
and it sounds like on average doing at least 250 to 350, probably more in cash flow. So you're looking at 3 to 4 grand a month. I mean, this stuff stacks up
And it
quickly.
it
And
comes
these
in
are
quick. Yeah,
all these are all horizontal income streams, right? They're all coming in horizontally. You're still doing your vertical thing, and eventually you go, active National Guard, and that's what you still do. So I think the whole like moral of the story here is that it's not impossible to do these creative financing deals, but you just have to understand the tactical and practical and what actually goes into getting these deals done. So with that in mind, David, as a kind of guy who focuses or who has done some of these creative finance deals, who do you need on your team besides the standard agent, lender, property manager? Because I would imagine you're looking at a title company, you're looking at a lawyer to draft up these promissory notes. Like, what do you need?
hmm yeah. So I've got a really good relationship with an attorney. So he draws up all the paperwork and the amortization schedules and all that stuff for me. You need a good contractor. Somebody that's very dependable, licensed. That has a good track record. Yeah, I mean, if you're buying off the market, you need a strong agent, real estate agent to kind of help you that understands, also like investment properties, not just residential, somewhere that you want to live. They understand like the investment property side of real estate. I mean, the list is on. I mean, you've got private money lenders,
Mm-hmm.
potential partners. there's you can't do this solo. That you have to have a good team behind you for sure.
Yeah. So there's another deal I want to talk about that you did that we were talking pre-show about, and this has to do with vacant lots. So this was another 3 portfolio deal. Was this the same seller or no? This is a different guy or girl.
No, so this was the deal I was just talking about, the three houses. I think that was like 2018 or so.
Hmm.
And then at that point, I realized like I really want to keep scaling. So I was at a school for the military, where we couldn't leave like well, it was just like I didn't have transportation, I didn't have a car or anything like that, so I was kind of stuck in my room. I was
Ah.
at like school for E6 school.
Hmm.
Um, so I was kind of stuck in my room if I wasn't in class. So I hopped on YouTube, and that's where I found like Bigger Pockets and a lot of the platforms out there. I'm like, wow, like people are I don't have to keep saving up my own money or doing seller finance. Like I can borrow money from other people. So I came back home from that school, and then I really started raising like private capital, finding hard money lenders, private money lenders, building up that network. And then I went from like right around 8 or 9 properties at that point, um, up to probably 30 within the next 18 months or so.
Wow.
Just,
That's
just
incredible.
yeah, just as fast as I could. I was really in growth stage, and then COVID hit. Um, and at the same time, I was looking to go into multifamily. So I think that's when we had connected prior a couple years back, is
Hmm.
through Tim or somebody. But I was looking to get into the multifamily, so I joined the multifamily mastermind, or the academy that you guys offer, and that was really great. Then COVID hit, and I kind of went into panic mode a little bit. So nobody knew what was going to happen. I had all these rentals. I was like, if everybody stops paying, like I'm in trouble. And I remember like at one point there was one month where it was like I had to replace like three HVAC units in the same month. COVID is like all over the news. They're saying like, well, tenants are going to stop paying, and I went into pure panic mode. But so I didn't buy anything for all of 2020. 2021 came around, and then I started buying up again. And at this time, like I said, I was probably around like 30 houses, 30 doors or so. Um, and then I hired an assistant, and we just went at it, as hard as we could. So 2021, 2022, I think we picked up like another 30 houses or something like that. But I say all that, I just want to kind of like fast forward through my story to get to this story that we're getting to.
Hmm.
So back in probably around April or May of 2022, I bought a portfolio of 11 houses from a seller. So this guy was actually going to court the next morning, uh, for a divorce,
Uh-oh.
and he had to sell off all of his rentals. So
Wow. So
the
he
night
was under the
prior,
gun, like
yeah,
literally under the gun. Because
yeah,
so if he doesn't sell this off, obviously it goes into arbitration pretty much.
yeah. I don't know what really happens on that side if he didn't sell them, but I just knew that he was getting a divorce. He had to sell them. The reason that he had to sell them, or the reason that he sold it for the price he did, is because he had to split the profits with his wife, or ex-wife, soon to be ex-wife.
Hmm.
So these 11 houses were in a market that I was not in yet. It was near Virginia Tech College, Blacksburg, Roanoke type area, Virginia. So yeah, these 11 houses, I bought them for I think 800, like 825, something like that,
Hmm.
$825,000, and they came with like 4 lots. So when I made my offer of eight, we'll call it 875, so I can't really remember if it was 825 or 875, but for 875, um, he threw the 4 lots in there, and he sold it for this price, even though it was worth close to $1.5 million, because he didn't want to split any money with his wife.
Yeah.
Like you never know,
You
like
never know. You never know what a seller's thinking or what they're going through or any of
yeah,
this stuff. But from your perspective, you're like, okay, I'm walking into $600,000 of instant equity. That sounds pretty awesome.
yeah, yeah, very very solid, and like I said, this was the night prior, so I knew like he needed something, and it was in a market that I wasn't in yet. So I was like, well, I'm gonna lowball this, and I did. I got with a private money lender, and he wrote me like a proof of funds. And this has all happened within 30 minutes. I got the deal, analyzed them through PropStream as quick as I could, figure out the value. I think I offered like I can't remember, like 70% or something like that. Um, yeah, I didn't even know about the 4 lots until I got the contract from the seller that had all 11 houses plus 4 lots.
Wow.
So super bonus there. But um, yeah, so we tackled that. We took that down. Then a few months later, the real estate agent that was representing the gentleman from that first package, he brought me another package of like nine houses, I think it was, or it was 11 more, but two
Hmm.
of them I just was very not interested in, just location and condition. So um, the 9 houses that he brought, I was at I think 700,000. He was at like 850, and we just the seller would not come off of that $850,000, and I just couldn't pay more than 700,000. That was the max price that I could go. So then we were going back and forth. I'm like, okay, well, how about if I just buy these 5 houses that we already agree on these prices? And he's like, no, it's all or nothing. So I was like,
Hmm.
well, I really want this deal,
Yeah.
but I just can't. I've already driven down there, walked the properties, met with the seller. We built the rapport and everything, and I've already spent so much time on this deal. I don't want to walk away from 9 houses over $150,000. But I knew I couldn't pay it. So then I remembered there's 4 free lots that I got. Um, so I was like, well, hey, look, I'll buy these houses from you, and I'll give you one of these free lots. That was like a half an acre. It was a decent sized lot, but I think the tax assessment on it was like $30,000.
Hmm.
So here we are. Like I'm saying, I'll give you $700,000. I'll give you this $30,000 lot. Can we do a deal? And he jumped on it.
Wow.
Um, it's $150,000 of difference there, and he took it over a $30,000 lot.
It goes to show you again, you never know what these sellers are want to do. So like I think so many investors, a lot of newbie investors, they get in their own head because they're like, I would never accept that. But
Yeah,
you're the buyer. Like it doesn't you have to stick to your numbers. You have to stick to it being non-emotional. And sometimes, I mean, you're talking about David, like, I cannot go over 700,000. I cannot do it. Was that a you thing based on the cash flow that you needed based on your like minimum metrics, or was that like a I'm out of cash?
that was so I raised the money from investors, but I know
Mm,
like my lender will only give me 75%,
I
of the
see.
value. So I'm only paying 70% because I need to build in like a little buffer there in case anything happens. So I knew like at 70%, it was $700,000. Like I'm not coming off that 700,000 unless I wanted to put money in the deal. But when you're trying to scale and you're trying to grow your business, you need to preserve as much of your own capital as you can. So, I just didn't want to put any of my own cash in the deal. So I was like, I'm not paying any more than 700.
So you got this deal again creatively because you threw in one of these lots, and you have it figured out. What happened to the other three lots?
So one of them, or two of them, I sold on the MLS.
Mm-hmm.
They were free lots. I think I got $15,000 total, so like 7,500 each.
Mm-hmm.
Which free lots, $15,000, and the buyer got a good deal, because that $15,000 that was they're probably worth 25 or so, so
Mm-hmm.
they got a
You can
good
go and
deal.
flip them, or reassign
Yeah,
them instantly. Yeah, sure.
yeah, and I'm cool with that too because it was free money essentially, So one of the lots I still have just because it's neighboring one of the houses that I have, and the tenant of the house has a garage on it, and he's kind of using that land.
Mm-hmm.
So I'm not. It's just an awkwardly sized lot where I'm not even sure somebody could build on it, so I'll just hang on to that lot for a while.
Yeah, there you go. So right now, you started investing 2016 ish.
Yep.
2017, 2016. So about 7, 8 years ago, call it.
Mhm.
And you've gone from nothing to now. How many doors do you have?
Well, I've done a lot of flips as well, but I've probably purchased around 75 homes. Right now, I'm sitting around like 55 doors.
So 55 doors, and they're all bringing you cash flow. What is your so that's mind you that's 55 independent streams of horizontal income that you've built yourself.
Mhm.
What is that bringing you in cash flow kind of for your business?
Um, Gross, I think it's right around like 600,000 or so, but profit, it's probably 12,000 a month, somewhere around there.
Yeah, about 12 grand a month, guys. 12 grand a month, that's more than most salaries. Like,
Yeah,
and you're still National Guard, full-time National Guard. You're doing your thing. And not to mention these 55 homes that you've built up, David. I mean, this is a retirement plan because you're paying these off. And the
yeah. I mean,
more, 10 years from now, you might have some of these completely paid off.
there's because like I said, I know the lender will give me 75%, so I know I'm immediately going to get 30% equity. 25% at the least,
Mm-hmm.
in each house. So yeah, I mean, like you said, I think right now I'm sitting close to 3 million in equity, across everything. And yeah, I mean, I've still got 10 years with the military before retirement, so who knows where I'll be here in 10 years.
Yeah, and that a level of freedom is really really exciting, and that's what we talk about when we talk about freedom. It's it's a level where you can, if you wanted to, you can quit the army tomorrow
Hmm.
and you'd be fine.
Yeah.
You'd be absolutely fine. You can do what you want, where you want, with who you want, but you love the army and you love what you do. So you don't have to. And having that
Yeah.
flexibility is just fantastic for you and your family. And I absolutely love it, man. Thanks so much for sharing these stories and inspiring all of those listening to this podcast right now. That's so cool.
Yeah, yeah, absolutely. And it's super ironic because I'm a recruiter for the military right now, and in 2019 I was in the like the S1 world, kind of like
Mm-hmm.
the human resource type world, and the army was like, no, you're going to go be a recruiter. Like I didn't put in for it or anything, so I was actually going to just resign and just leave the full time side of it. But I tried it out, and it's super ironic because I was like, I'm gonna grow my rental portfolio so that way I can financially afford to leave and resign from the full time National Guard world. But I ended up loving recruiting, so it was like a win win. I grew my portfolio and I love my job, so that's
Boom.
a super win.
Yeah, you're building your portfolio to leave, meanwhile signing other people up to come on full
Hey,
time.
yeah,
Yeah. They
yeah.
they don't know. So like, do you even talk about real estate? Like when someone comes to you, I'd be talking about it all the time.
Yeah, no, no, actually, yeah. I everybody that I enlist, I try to mentor them. I've got several people that I've enlisted that I've given them books or I'm an open book. I'm like anytime you have questions, just hit me up and I've mentored them. I've probably got uh 10 to 12 people I've enlisted that are after the real estate, which I think
They're
is
doing
just
deals.
great, especially because they're all 18, 19 years old.
We got to bring them into the active duty passive income community, man.
I do, I do. I pitch it all the time, man. I love this community.
I love that. I love that so much. All right, David, man. We're running out of time. I got to take you to the bonus round. You ready?
Yeah, ready.
All right. So these are the same four questions we ask each and every guest who graces their presence on our podcast. Question number one for you: what book or software is really crushing it for you lately?
So I've been in love with the 10x rule, 10x rule mentor Grant Cardone. I know he's very controversial, and some people hate him, some people love him. But I read the 10x rule, loved it, read it again, uh, or audiobook. I have a long drive every
Mm-hmm.
day, so did it again. And then the 10x rule mentor came out, and I've probably listened to that 3 or 4 times. And every time I listen to it, I'm like, I need to do that. So I've really implemented a lot of stuff to kind of help really grow and expand the business. So that book is really great.
That's awesome. I love that. Question number two: who's your biggest hero and why?
So that's a question I really stood on a lot. So I've got a lot of great people that I think are just very uh, generous in what they do. So I would say there's a local person in my community. His name is Nathan. He started where I am. He's 10 years ahead of me. So he's doing massive deals, and he's uh, he's who I am to the people I recruit. They can come to me for anything, and same thing like Nathan. He's been an extreme help. Anytime I have a question or need a referral of a bank or something like that, Nathan's my go-to.
I love that, and it's always this just goes to show you your network is your net worth, because without the
Absolutely.
connections, when you build a relationship with someone else, you instantly open up their entire network to you and your entire network, and that is how it gets done. So, um, it's funny. I had a call with someone yesterday, and they were talking about like, man, you like seem really good. They're talking to me like, you seem really good at like networking and talking to people and all this stuff. And they're like, what's your secret? And I was like, I don't have a secret, man. I just open
Do
up my network. I open up my network, and when someone tells me, what they're looking to do, I connect them with someone I think could be a helpful connection, and I expect absolutely nothing in return.
hmm
And I just move on with my day. And you know what? What goes around comes around. And that's just how life works, cuz most people don't do that. Most people in the business world, especially in the corporate world, they live on this transactional basis. But if you want to set up transformational relationships, like it sounds like the one you have with Nathan, you just share. Just share what you got, share what you know, and just don't expect anything in return.
Yeah,
And it's a wonderful strategy. Um, or just honestly, it's a great way to live your life too. It's a lot happier.
yeah, yeah. I think
uh,
it's really important. Like I said, like your network is your net worth. Like people think all the time, like I don't have the money to do real estate, but are you getting yourself out there and finding the people that have the money to do it, or are you just saying, I don't have the
mhm.
money, so I'm not going to do it?
Yeah, 100%. All right, let's lighten it up a little bit, man. What do you like to do for fun?
So lately, I've been really into like kind of learning to play guitar. I've always kind of like played around with it, but it's become a big habit here lately. The gym, always enjoy going to the gym. And then I've got three kids, 6 year old. Within the next 2 weeks, my two daughters will be 3 and 1. So um, it's a busy household. It's a busy life.
It's a busy household, but the good news is you have 12 grand a month coming in independent streams of passive income. So you got some things covered and you don't have to worry about your financial health or your financial freedom or anything like that. So you get to focus more on the family and the things that you love. And that's the whole point of this podcast. And that's the whole point of what we do at ADPI. All right. Final question for you. Arguably our most important question here, David. If you had three nuggets of wisdom to give to someone like, I don't know, the people that you recruit every day,
Yeah.
how would you? So you probably give out three nuggets of wisdom every day. What's your standard three to folks who are trying to get into real estate investing?
Yeah, I just touched on this a little bit here a moment ago, but definitely network. Get your name out there. Even if you're not doing deals, if you're doing deals, like just put it out there. Even if you're not doing deals, if you're just looking at learning some of the a little bit into the real estate world, you're gonna know so much more than people that don't know anything about real estate. So even though you're not doing anything, like, you can still put your name out there and help teach things. So I just tell them, like, network as much as you can. That's one. Number two, I would say, is start raising private capital.
Mm,
Especially with interest rates in the banks and hard money loans, like, those rates are getting pretty high and pretty steep. So go ahead and start, trying to raise up capital from friends, family, go to local meetups and network, and just start raising the capital. So that way, as soon as you find the deal, you can jump on it. And then number three, I would just say start learning as much as you can. Every day, get a podcast or a book or YouTube video, or do something. Hop on a 30-minute phone call with somebody that's doing it, and just learn as much as you can.
yeah, taking that action is super critical, and you're absolutely right about the interest rates as they continue to climb up. And the interesting thing about this is people are like, "Oh, who am I going to raise money from?" And I always say, well, why don't you look in that brick that's in your pocket? You know that thing?
Yeah,
Uh,
yeah, you got
you probably got a
400
couple
people
hundred
in there.
people in there. Yeah, yeah. So that's the first place to look. But honestly, because of the volatility of the stock market, and people have been pulling their money out and they're holding it and they have no clue what to do with it. But if
Yeah,
you can cement yourself as a real estate expert by simply studying the industry, taking action yourself, and and being a part of our community and other communities, and just doing it and walking the walk, you will be able to begin to attract folks who are like, oh man, David knows what's up.
yeah,
And
yeah. You
and
just gotta get your name out there.
it's not hard. So yeah, I love that advice, man. That's incredible. For folks who want to get in touch with you and be a 10x mentee, how can they do that?
I love it. Yeah. So I'm on Instagram, David Sanford 215. You can find me on LinkedIn, Facebook. Twitter. I'm all over the place. So definitely, I love to help people. I wish when I was getting started in the business, I didn't really have that mentor until I was a couple of years in. So if anybody's just starting out and they just want to kind of pick my brain, happy to do so. So just reach out to me.
That's incredible, man. I love that, and I really appreciate your time coming on here. I know you're busy with the kiddos and the job and the 75 doors and all of that stuff, or 55 doors or whatever it is. So yeah, I thoroughly appreciate it, and I'm sure we'll have you on again.
Yeah, man, sounds great. Got a big deal in the works. I'd love to talk about here in a couple months.
Ooh, don't tempt me with a good time. All right, we'll see you
I
next
will.
time, David.
Yeah, thanks, Kevin. Appreciate that.